Welcome to our channel. Today, we're diving into a unique and fascinating perspective on investing. What can Charles Darwin's evolutionary theory teach us about successful investment strategies? It might sound a little unusual, but stay with me, because the parallels between nature and the financial markets are truly mind-blowing. Whether you're a seasoned investor or just getting started, this is a video you won't want to miss. So sit back, relax, and let's explore how we can apply the laws of evolution to build a long-term investment strategy that not only survives but thrives. Before we dive into the main ideas, let's start with the basics. Charles Darwin's theory of evolution is centered on the concept of natural selection, the idea that species adapt to their environments over time, and those best suited to their surroundings are more likely to survive and reproduce. Now, you might be wondering, how does this relate to investing? Think of the stock market as an ecosystem, where companies are the species. Some will thrive, while others will struggle or even disappear. As investors, we want to build a portfolio that evolves over time, adapting to market changes and selecting businesses that have the highest chance of survival and long-term success. That's the Darwinian approach to investing. So, what does this look like in practice? Let's break it down into 3 key principles that can guide our investment decisions. First up, risk management and simplicity. One of the most important lessons we can learn from nature is the need to manage significant risks while keeping things simple. In the wild, animals and plants evolve survival strategies that help them avoid catastrophic risks like predators or environmental disasters. In investing, we need to do the same. Think of honeybees, for example. They choose their nesting sites carefully, using a simple decision-making process to avoid dangerous locations. As investors, we need to follow a similar approach. By focusing on simple, repeatable processes, we can avoid taking unnecessary risks that could wipe out our portfolios. That brings us to our second principle: invest in high-quality businesses. Just like in evolution, where the fittest species are more likely to survive and reproduce, in the stock market, high-quality businesses are more likely to thrive over the long term. But how do we identify these businesses? Look for companies with strong competitive advantages, consistent earnings growth, and a track record of adapting to changing market conditions. You want to invest in companies that are built to last, businesses that can withstand the inevitable ups and downs of the market. Don't be afraid to pay a fair price for a high-quality company. Remember, it's better to own a great business for the long term than to chase after short-term gains in mediocre companies. Now, let's talk about the third and perhaps most crucial principle: owning your investments forever. This is where Darwin's long-term perspective comes into play. Evolution is a slow process. It takes time for species to adapt and grow stronger. Similarly, in investing, success doesn't happen overnight. We need to be patient and allow our investments to grow and compound over time. Warren Buffett, one of the greatest investors of all time, often says that his favorite holding period is forever. By committing to a long-term strategy, we give our investments the time they need to truly flourish. This doesn't mean that we never sell an investment, but rather, we should avoid being reactive to short-term market fluctuations. Trust the process, and let the power of compounding do its magic. Speaking of long-term thinking, it's important to avoid overconfidence. Just as biologists studying evolution know that they can't predict every twist and turn in nature, investors should recognize the limits of their own knowledge. No matter how much research we do, there's always a level of uncertainty in the markets. Overconfidence can lead to poor decision-making, like taking on too much risk or holding on to a stock for too long, hoping it will turn around. That's why humility is key. Acknowledge that you won't always get it right, and build a diversified portfolio that can weather the inevitable challenges that come your way. In investing, it's better to be cautious and prepared than to assume you know more than the market. Let's take a moment to illustrate these ideas with a real-world example. Think back to the dot-com bubble in the late 1990s. During this time, there were countless internet companies that seemed poised to take over the world. Investors were overconfident, thinking that the rapid growth of these companies would continue indefinitely. But many of these companies lacked the fundamentals needed for long-term success. When the bubble burst, only a few high-quality businesses, like Amazon, survived and went on to thrive. This is a perfect example of Darwinian selection in action. The companies that adapted and had strong business models survived, while those that didn't were wiped out. As investors, we need to focus on finding the Amazons of the future, companies that have the resilience and adaptability to succeed in the long run. Another key takeaway from Darwin's theory is the importance of adaptability. Just as species must adapt to their environments to survive, businesses must adapt to changes in the market. Think of companies like Apple or Netflix. Both of these companies have continually evolved and adapted their business models to stay ahead of the competition. Apple started as a computer company, but over time, it expanded into music, phones, and now services. Netflix began as a DVD rental service, but quickly pivoted to streaming, and now it's a global entertainment powerhouse. As investors, we should seek out companies that demonstrate this kind of adaptability. Look for businesses that are constantly innovating, finding new ways to serve their customers, and staying ahead of the curve. So, how can we apply all of this to our own investment strategies? First, remember the 3 key principles. Manage risk through simplicity, invest in high-quality businesses, and commit to a long-term strategy. But beyond that, we need to stay flexible and open to change. The market is always evolving, and we need to evolve with it. Keep an eye on emerging trends, and do not be apprehensive to adjust your portfolio if necessary. At the same time, resist the urge to make drastic changes based on short-term market movements. Stay disciplined, stick to your strategy, and focus on the big picture. Investing, like evolution, is a marathon, not a sprint. To wrap things up, let's revisit our Darwinian investment strategy. By applying the principles of evolution to the stock market, we can build a portfolio that is resilient, adaptable, and primed for long-term success. Just like in nature, the goal is not to be the fastest or the flashiest, but to survive and thrive over the long haul. Remember, investing is a journey, and the key to success is patience, discipline, and a focus on quality. By managing risk, investing in the right businesses, and staying committed to your strategy, you can achieve financial success that lasts a lifetime. Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe to the channel for more investing tips and strategies. We'd love to hear your thoughts, so drop a comment below and let us know how you approach investing. And don't forget to share this video with your friends who might find it useful. Until next time, happy investing!